In today's video, we're comparing Yieldmax funds to Rex Shares to see who has a better fund to not only live financially free from your 9 to 5 with, but to also play the AI growth theme with. These funds help us earn over $400,000 per year in dividends, as you can see below, and live financially free from our 9 to 5. If you need help doing the same, email me for my e-guides at akintodd48@gmail.com. We use some margin to get these dividends, and we're outperforming the market in the process. We're up 13% for the year now. The S&P is up 11, the Nasdaq's up 10, the Dow's up 4, and the Russell's up 2. So even with this 400,000 in margin debt that you see me have here, we're still outperforming the market even with the recent crash, okay? Even during a 15% Nasdaq crash, we're still outperforming all the indexes with that leverage. And that's because we have a unique blend of these funds, these Cornerstone, Yieldmax, Defiance, and Rex Shares funds that not only give us these dividends, but they give us days gains. Okay, we're up 23,000 today, or 1.99%, as you can see here. And if you look above, you'll see that that's in line with the indexes. So not only are we beating the indexes on a year-to-date basis, but we're beating the indexes on a daily basis. And we beat the indexes handily today, and it wasn't all from Cornerstone. Usually half of my gains come from Cornerstone or so, but today it was from AIPI, FEPI, and Yieldmax funds. And so we're going to talk today about which fund we should have in our portfolio at the highest weighting, okay? Which fund should we have more money in, Yieldmax or Rex Shares, FEPI and AIPI, and which funds play the AI growth theme better? So again, from our day's gains today, 23,000, only a fraction of that was from Cornerstone, okay? And that's usually not the case. Usually Cornerstone is half of my gains, but now we're diversifying into these other funds like Roundhill and Rex Shares. And you can see today FEPI was up 3% and AIPI was up 3.5%. So it has a little bit higher beta than FEPI. And if you go look at the holdings of AIPI, you'll see that it has some nice growth stocks, but they're not all indexed to the S&P. They're mostly in the Nasdaq and something like a Datadog that's not in the S&P. So this is going to be more volatile, okay? It's going to have more movement. That's why it was up 3.5% today. Palantir is its top holding. CrowdStrike, it's another high beta play. It's a cybersecurity play, and you have NVIDIA and ARM, which are semiconductors. So that's going to be a very high beta fund, AIPI, and it gives you the 35% dividend to compensate for that volatility, whereas FEPI has the Mag 7 names roughly, okay? They do have some other names like Palo Alto, which is not a Mag 7 name, but nonetheless, FEPI gives you a 25% dividend and it has less volatility, whereas AIPI has a 35% dividend and it has more volatility, judging by its holdings and its day's gains today. Today we're up 3.5%. The Nasdaq itself was up 3%. So they correlated well with the indexes. The only problem with FEPI and AIPI is that they're not fully diversified, as you can see by their holdings, and they're also not low maintenance. QQQ is 30% maintenance, whereas let's say a FEPI is 50% maintenance, okay? View margin maintenance requirement 50%. So this is a killer to the fire lifestyle when you're using margin to get ahead, okay? This 400,000 that you see of margin debt, when you're using margin debt to get ahead, you need to keep your available withdrawal high, okay? Yes, for every $1 you put in your account, you get $4 of purchasing power. If I wanted to invest all of that million, I could at, let's say, a 40% yield, and that's another 400,000 that I could be earning in dividends on top of my 400,000. But you want to always keep a nice cushion for error, okay? You want to have high available withdrawal so that you can avoid margin calls while still paying your bills at the same time. I can withstand over a 20% correction in the market right now, even after a 15% correction, and still pay my bills, okay? I can swipe my E-Trade card and go wherever I want in this world. Even with this debt, I can swipe my E-Trade card and buy whatever I want with it with much lower interest than most credit cards, okay? I've negotiated my interest down twice with my margin debt. Many of my clients who bought my e-guides did the same thing. When you buy my e-guides, you get my phone number so you can call me anytime you have questions. I'm not worried about my margin interest, and I'm not worried about my margin leverage, by the way, because our dividends of over 400,000 per year we'll pay back our margin debt in less than a year. So the leverage goes away each month, and that's how we were able to withstand that market correction. And even on down days, we weren't down much. Okay, we're outperforming the markets on down days, if you remember, but on up days now, you can see we're also outperforming. How do we outperform on the down days and on the up days? How are we up $23,000 today and not down $23,000 by the same token on the down days? Okay, if the market was down 2%, we'd be down 1.5%. How is that possible? Well, because Cornerstone was falling less and Defiance funds were falling less. AIPI and FEPI were falling more, okay? And they also have 50% maintenance, so they're sucking up all of my equity at the same time. If you need help understanding maintenance, that's in my volume 3 e-guide. So FEPI and AIPI, okay, they're off to a nice start right now, you know, to resume that uptrend in the NASDAQ. But they have 50% maintenance, so they're sucking up 50% of my equity, and they fell hard during the recent crash, okay? If you look at a chart of FEPI, you'll see that it goes sideways mostly, but then it crashed, okay, during the crash. Everything crashed, to be fair. But when it's only going sideways and not giving you gains to the upside, and then it can just crash by a huge amount, you know, to me, 50% maintenance with a 25% yield is not really worth it when I can go to Cornerstone that has 30% maintenance. It moves upward left to right, as you can see here, and it also has around a 20% dividend. It sets its dividend at 21% every year, and it drips its dividend down at the NAV for free money every month. FEPI and AIPI don't do that. So that's how I was able to withstand the market crash, okay? Keep my available withdrawal high was Cornerstone has low maintenance. And as you can see here, it's a 5-star fund if you don't know about Cornerstone, and it moves upward left to right on its chart there, as you can see on Morningstar. So Cornerstone, it moves upward left to right and 30% maintenance with the similar yield as FEPI. Why would I have more money in FEPI? I'm going to keep more money in Cornerstone. I have about 400 grand in Cornerstone. And so, you know, with low maintenance, I have to do that. And the key with Cornerstone is to factor back in dividends and drips. If you know, again, buy it up here at this price, it's dripping the 21% dividend down here at the lows for free money every month. Yes, it goes sideways to down on its chart on an E-Trade or on Y charts. I get a lot of hate with Cornerstone, so I have to explain this in every video. See, it goes sideways to down here, but as I just showed you on the Morningstar chart, it goes upward left to right on its chart. That's because you have to factor back in dividends, drips, and rights offerings for Cornerstone. And that's in my volume 4 e-guide if you need help playing Cornerstone. So we're all watching the rights offering closely with Cornerstone. I have to say this in most videos because that's what stands in the way between us and financial freedom, is the rights offering with Cornerstone, or when Cornerstone reaches high enough premiums to where we have to sell out of it, okay, and reload at the lows again. So we alert you of the Cornerstone rights offering announcement here in the Discord chat room, okay? So Discord is a free app. You can download Discord on your phone. I didn't know about Discord before I started YouTube, but all of my members told me to start a Discord so we could do the alert service with Cornerstone there. So Discord's a free app, and when you buy my e-guides, I send you a link to Discord for life, so you have that chat room for life and all those members that you can talk to whenever you have questions about anything, okay? So Cornerstone, it moves upward left to right on its chart. It gives you those average 20% premiums per year. Why would I be in FEPI when it doesn't average any premiums per year? It just goes sideways and gives you the 25%. So yes, I'm going to be in FEPI because there are a lot of good things to be said about FEPI. I mean, it's giving you a steady 25% dividend. It's going sideways left to right, but it's not really decaying on its chart, okay? And that's a very good sign, okay? That's a very nice feature of FEPI. But again, I don't like how it fell during the downturn with 50% maintenance. You can go to other brokers with lower maintenance, but they might not have the special drip for Cornerstone, so just be aware of that, okay? Robinhood and Interactive Brokers don't have the special drip for Cornerstone, but they have lower maintenance and lower margin interest. So I expect AIPI to act a lot like FEPI, and of course AIPI is a more direct way to play the AI theme. But what about Yieldmax? How is Yieldmax doing? Okay, YMAX, how is that chart looking? Well, as you can see here, it decays pretty significantly, and it has around a 35% dividend, a 40% dividend. It shows here 44%. So AIPI has a similar dividend, 34%. YMAX, maybe, you know, it's in the high 30s, low 40s. but YMAX shows a lot of decay, okay? So you might want to consider AIPI over a YMAX, but YMAX has a little bit different diversification than an AIPI, okay? It has some JP Morgan, Exxon, it has some other steady blue chip names in YMAX that have their advantages, and that's why I have some YMAX in my account. But then you also have YMAG. This is the Yieldmax Mag 7 fund, and as you can see on this chart here, it does move sideways to up. It moves upward, left, or right, as you can see there. So I definitely want to buy more of this fund when I can, because it gives you some gains and it gives you the 40% dividend monthly. So it gives you upward, left, or right gains, not a lot of erosion there, and again, it gives you this 40% dividend. So I want to buy more of this on a dip when I can, but I have to leave it small because, again, Yieldmag is 50% maintenance. So YMAX and YMAG are 50% maintenance, and they showed in the recent crash that they can fall pretty significantly, all right? You know, they recovered well by the end of the day, but what if the crash had continued on the Black Monday? You know, how would FEPI, AIPI, YMAG, and YMAX have fared, okay? They might have continued to fall precipitously, whereas the indexes would have been maybe down 3 to 4 to 5%. So if the indexes are down 3 to 4 to 5%, but our Yieldmax and Rex shares are down 10 to 15%, we're going to be getting creamed with our margin. Even if you're not using margin, you want to watch these funds, okay? You don't want to have this kind of underperformance in your account. But with margin, you're going to see a big drop in your account, and you're going to cannibalize your available withdrawal if you put too much in these names, because again, they're 50% maintenance. So I like YMAG to play the AI theme, and of course we like AIPI to play the AI theme, but the question really comes down to what are the dividend yields and what is the maintenance, okay? And then what is the upward, left, or right movement like in these charts? Do they go sideways? Do they move upward, left, or right? Or do they move down on their charts? YMAX moves down on its chart, okay? AIPI and FEPI, they look like they move sideways. Yieldmag moves up on its chart. And that's because the Mag 7 names had probably the strongest performance compared to the rest of those laggards that were in the S&P. You know, even like an Exxon Mobil, that name has lagged somewhat. AIYY, the other names that are in YMAX, those random names that they have in YMAX, the fund of funds, not all of them are doing well, but most of the Mag 7 names are doing well. That's probably why YMAG had better performance on its chart, but you have to go with the Mag 7 names. So that's why I like YMAG, but why don't I put more money in each of them? Well, they have, again, 50% maintenance. So I have to watch my maintenance when we're dealing with margin. Even without margin, you want to watch your performance. But in a crash, you have to watch your maintenance, and 50% is a killer, and these funds move down big in a crash, so beware. That's why I put so much money in Cornerstone and also Defiance, okay? Defiance has been doing well, and as you know, I've been pounding the table on Defiance and Roundhill funds lately. All right, they moved down less than the market on a down day, okay? And they moved up with the market on an up day, okay? How do you find that unique blend? I don't really know, okay? These are really great funds in my opinion, QDTE. I don't get compensation from any funds, okay? I'm just sharing what works for me. So QDTE was up 3% today. QQQY was up 1% today. So QQQY gives you some upward gains. The other day, QQQY was up more than the NASDAQ. The NASDAQ was up 1%. QQQY was up like 1.25%. I documented it in my video. So it gives you some days gains, but it did not fall as hard as the market. That's why I like QQQY, and it has 30% maintenance. Okay, so that's how we outperformed during the recent crash. Was we had Roundhill and Defiance. We had a lot more money in them than Yieldmax and FEPI and Rex shares, and they have lower maintenance as well. So this is how we outperform. Cornerstone is also low maintenance, and it fell less than the indexes, except for on Black Monday. Okay, when we had the crash Monday, yes, Cornerstone fell with everything else, but Cornerstone was just due for a correction, because if you look on its chart before the crash on Monday, it had been holding up better than the rest of the market. So that's how we're outperforming, and that's why I don't have as much money in Yieldmax and Rex shares, because they underperformed during the crash and they have higher maintenance. Okay, so I stick with the lower maintenance funds that are more diversified, like QQY and Cornerstone. These are the full indexes. Yieldmag and Yieldmax are not fully diversified. Either is FEPI and AIPI, and those all have 50% maintenance, whereas QQY actually has 30% maintenance. And again, so does Cornerstone. So you have to keep living in these numbers, okay? The maintenance and the upper left or right movement and how much they fell in a down market. And also QQY raised its dividends in a down market. You know, these zero DTE funds like Defiance and Roundhill raise their dividends in a down market, but Yieldmax will lower their dividends in a down market. So when the market ends up going higher eventually, you have to have Yieldmax because they'll raise their dividends in an up market. So you have to have a unique blend of all these funds. That's how we're outperforming the market with this margin usage of over 400,000. Okay, it looks like a lot of margin, but again, my dividends pay that back in less than 1 year, and we're still outperforming the market in the process. We're up 13% for the year. And so we're beating the market on a year-to-date basis and on a daily basis with these funds. Don't forget, you need to hedge your positions with tech. Okay, if you have a lot of tech names like me, we had our tech puts on, we had our NASDAQ puts. Those are up over 1,000% in the recent crash. And we sell our puts on the NASDAQ in these various asset classes so that we can lower our margin and lower our risk in the process, because when you sell put options, it lowers your cost basis. It lowers your risk because you receive these premiums, and they move down less in the market on down days because they are leaps. I sell puts on long-term options, not short-term options, which reduces the volatility. So it reduces the volatility, reduces your margin, and it reduces your risk because you lower the cost basis when you sell these options, okay? And after the crash, you can sell these options for even better premiums and make a lot more money. That way it pays down your margin even further. So if you need help selling options, that's in my Volume 6 e-guide. And if you need help hedging your portfolio with options, that's in my Volume 5 e-guide. So don't forget, if you have a lot of tech names on and you use margin like me, to keep some options on for crash insurance protection like we had during the recent crash. They really helped us a lot and kept our available withdrawal high, okay? So if you need more help doing what I'm doing, email me for my e-guides at akintodd48@gmail.com. When you buy my e-guides, you get free access to Discord for life, and you get my phone number for life, so just keep this in mind. All right, if you enjoyed the video, click like or subscribe. I really appreciate it when you do, because it helps push this video out to more people, okay? And I'll talk to you soon, everyone. Thanks.